Everyone has heard the phrase pre-construction, but very few people understand what they actually bought. At its core, pre-construction means committing to a property that does not exist yet. You agree to buy a condo years before it's built, at today's price, with the expectation that by the time it's finished, the market value will be higher. When the building is finally completed, you either move in or sell it at the prevailing market rate. That's the promise. In practice, the process is far more complex and far riskier than it sounds. When someone buys pre-construction, they don't take out a mortgage right away. Instead, they put down a staged deposit, usually between 15 and 25% of the purchase price, paid over 1 to 2 years. That money is locked in and typically non-refundable. The buyer does not yet know what their mortgage rate will be, what the condo will be worth at completion, or whether the bank will even approve the loan. During this period, the developer uses those deposits as proof of demand. Banks rely on pre-sales to decide whether a project is financeable. Without enough buyers committing early, the building doesn't get built at all. So pre-construction buyers aren't just future owners. They're effectively underwriting the project. That system worked for a long time. And because it worked for so long, people began to treat it as safe. For investors, the appeal was obvious. You could control a property worth hundreds of thousands of dollars with a relatively small upfront deposit. You didn't need to carry a mortgage for years, and historically, by the time the unit was finished, prices had usually gone up. For end users, the appeal was different. Pre-construction offered a way into the market without having to compete in bidding wars. It felt like a structured path to ownership. Put money down slowly, wait a few years, then move into a brand new home. Both groups were relying on the same assumptions, even if they didn't articulate them the same way. Those assumptions are what broke. To understand why, you have to look at the numbers. Let's walk through a realistic example. Imagine a buyer purchased a pre-construction condo in the GTA in 2021 for $750,000. They put down a 20% deposit, $150,000, paid over 2 years. At the time, interest rates were around 2%. Prices had been rising steadily for over a decade, and rents were climbing alongside population growth. The buyer expected that by completion, the condo might be worth $850,000. That expectation wasn't speculative. It was consistent with what the data had shown for years. Under that assumption, the math worked. At closing, the remaining balance would be $600,000. If the unit appraised at $850,000, the bank could lend up to 80% of that value. $680,000. There would be no financing gap. The buyer could close comfortably, refinance if needed, or sell at a profit. That was the logic. Now fast forward to today. Construction finishes in 2024 or 2025. Interest rates are no longer 2%. They're closer to 5.5 or 6. Condo prices haven't exploded upward. In many cases, they've stalled or dipped. Instead of appraising at $850,000, the unit comes in at $650,000. Banks lend based on today's value, not yesterday's contract. 80% of $650,000 is $520,000. But the buyer still owes $600,000. That leaves an $80,000 gap, cash that has to be produced immediately to close. This is where pre-construction breaks. Now add interest rates. At 2%, a $600,000 mortgage would have cost roughly $2,500 a month. At today's rates, even a smaller mortgage of $520,000 costs over $3,200 a month. The mortgage is smaller, but the payment is higher. Then you add condo fees, property taxes, insurance. Suddenly, the all-in monthly cost is over $4,000. Rent, meanwhile, hasn't kept up. A one-bedroom condo in much of the GTA rents for roughly $2,800 to $3,000. That leaves a negative cash flow of over $1,600 per month, nearly $20,000 a year. This is why the investor model collapsed. For years, investors accepted modest losses because appreciation did the heavy lifting. But when prices stopped rising and rates jumped, the losses became too large to ignore. That's why some investors are choosing to walk away from deposits. It sounds irrational until you run the numbers. If you've already put in $150,000, but closing requires another 80,000 plus years of negative cash flow, the question becomes whether it makes sense to throw good money after bad. For an investor, walking away can be a cold, rational decision. For an end user, it's devastating. End users often use their life savings for that deposit. Walking away doesn't just mean losing money, it means losing their chance at ownership entirely. They don't have the luxury of treating the deposit as a sunk cost. Their choice is often between stretching their finances to the limit or starting over from zero in an even more expensive rental market. This is where the story becomes misunderstood. People ask why anyone thought this was a good idea in the first place. The answer is simple. The data supported it. For nearly 2 decades, GTA real estate rewarded patience. Condo prices rose steadily from the early 2000s through 2020. Even downturns were short-lived. Every scare, like the financial crisis, the stress test, the pandemic, ended with prices going higher. Interest rates reinforced that confidence. Cheap money made leverage safe. Carrying costs were manageable. Negative cash flow was tolerable. Rental demand appeared unstoppable. Population growth was strong. Vacancy rates were low. Immigration concentrated heavily in urban cores. The assumption wasn't that rent would cover everything. It was that it would reduce risk while prices did the rest. Banks validated the strategy. They financed towers only after enough buyers committed. Mortgages were approved easily at completion. The entire system signaled that pre-construction was not just acceptable, it was normal. People weren't gambling. They were extrapolating from history. That's why this moment feels so jarring. The system didn't slowly degrade, it flipped. So is there any upside left? Yes, but it looks nothing like the upside people were sold. The era of guaranteed appreciation is over. The idea that you can buy pre-construction, assign it before closing, and walk away with a profit is effectively gone. Rent no longer covers debt by default. Rates no longer protect leverage. Any future upside depends on time, not timing. Long-term housing shortages still exist. Population growth hasn't stopped. It's slowed. Construction pipelines are shrinking as projects are canceled. That supports gradual price growth over many years, not fast rebounds. Interest rates matter more than sentiment. If borrowing costs eventually normalize lower, affordability improves and demand stabilizes. But that's a macro decision, not a promise. For investors, upside now has to compete with alternatives. If cash flow stays deeply negative, many will exit permanently. The market will lose a class of buyers it quietly depended on. For end users, upside isn't profit, it's stability. Locking in housing, avoiding rent volatility, and having certainty in an uncertain market. Pre-construction can still work, but only if it's treated as a long-term housing decision, not a leveraged trade. The real lesson isn't that buyers were reckless. It's that a system built on cheap money, rising prices, and institutional validation normalized risk without explaining it. When one assumption broke, the entire model cracked. Pre-construction didn't die because condos are useless. It broke because the rules changed, and the system never told people what would happen if they did. That's the story. Not of greed, not of stupidity, but of a housing model that worked, until it didn't. And the consequences of that failure are only beginning to show.